Come on.
Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, April 30th, 2023. We've got another great show for you this week as members of the media, academia, financial services, and government stand by to analyze all the news and events for the week. So sit back, relax, enjoy this episode of BRN Sunday.
But if you're tired of the same old story, turn some pages.
Well, we're going to kick off the week, as we always do, with a look at what's happening on Capitol Hill in terms of regulation, legislation, litigation, arbitration. You know them as the Legal Eagles. They're also known as David Levine, Kevin Walsh, and both are principals with Groom Law Group. That's an employee benefits law firm based in good old Washington, D.C. Gentlemen, great to talk to you. Thanks so much for joining us on the program this morning.
It is great to be here, Jeff. We wish everybody a wonderful rest of the weekend, and we're excited to chat with you today.
So, thank you, David. And Kevin, I want to throw to you because a lot of people in the industry, outside the industry, trying to get their arms around regs and Secure 2.0. And I think you might have an update, you and David might have an update on when we can expect such regs, because there are 90 plus provisions that need regulations.
I think that is kind of the story of the first half of the year has been that we know that the Labor Department is very busy. And I think at some point soon, we're going to start seeing the results of their business. As you highlighted, Secure 2.0, it instructed them to do, a ton of regulatory activity. And we're aware that folks over at the Labor Department are working diligently to, get those regulations out in response to Secure 2.0. We also know that there's a handful of other regulatory projects that, DOL has been working on, last fall, or last summer, and that are nearing completion, that are unrelated to Secure 2.0. And so some of what we're seeing is, the Labor Department, they've got a fair amount of resources, but at some point they've got to be a little bit spread thin trying to get these projects complete. And what we've been hearing is that, in terms of, what's coming down the pipe, one thing we've talked about and came up last fall was, there's a proposal that related to when an entity could act as an asset manager for an ERISA plan, and have relief from some of the not conflict related, but the other prohibited transaction prohibitions. What we're hearing is that regulation that regulates asset managers and the criteria they have to meet for that exemption is coming down the pike, and I wouldn't be surprised if we start seeing that head over to OMB in the next couple of weeks, and if it's not public in the next month or two. So that's one big reg project that Labor looks like they're going to complete, while also working on the Secure 2.0 regulations. A second thing that we've seen, a lot of effort put into DOL, that DOL has put a lot of effort into, relates to individual exemptions. And one thing that we've complained about bitterly, and I David complains bitterly. I want to put words in his mouth. Make him the one who complains bitterly, not me.
Well, Kevin, what happened to the complaining Kevin that I know and love? You've gone soft.
It's probably
just go.
It's probably me that complains more than you about these things. But for a long time, essentially from 1974 to I'd say 2010-ish, one of the great things was that if you had an idea that could help retirement plans, if you had something that you could do that would be helpful to plan participants, and ERISA's prohibited transaction rules made it so you need an exemption or you couldn't do it, folks were going into the Department of Labor with ideas, and with some regularity, the Department of Labor was granting individual exemptions that would say, if you meet these criteria, we'll let you go forward with that idea. In recent years, there's been kind of a slowdown in individual exemptions being granted to entities that want to innovate with plans. And last fall, they proposed an update to the framework for going in and applying for one of these exemptions. Now, we're looking forward to seeing what the final rule looks like, because new procedures that are designed to streamline the process could really, restart that program and allow for some of the innovation that we've been hoping to see in the retirement space. As kind of a green shoot, and kind of I think is a signal of goodwill from the agency. In the past year, we've seen 12 individual exemptions granted, which, I think that's a record going back a number of years. I think we'd love to see more, but there's at least some green shoots signaling that there may be some willingness to work with folks on individual exemptions. Beyond that, I still think that we could see, revisions to other exemptions later this year. There's always the possibility of more action on fiduciary. That being said, as you highlighted, Jeff, Secure 2.0 has, a vast treasure trove of regulations that the Labor Department was instructed to work on. And for many of those regulations, there's tight deadlines where they were told to act within 12 months of enactment, really putting them at the end of the year. If they want to do a proposed rule and a final rule, they really need to start getting those rules out, in the next month or two, if they want to have it done by December. Otherwise, I would expect in the second half of the year that we see a bit of an onslaught of rules that don't go through notice and comment before they become final, but maybe they have a comment period afterwards. So interim final rules.
David, do you want to pick up the conversation and respond back to your alleged bitterness?
Well,
So
first
bitter.
of all,
So bitter.
first of all, it is interesting how one, I won't say his name, it might begin with a W, takes his statements and attributes them to a third party when talking publicly. It's fascinating. But yeah, I also do find it interesting how such unnamed person was asked a question about Secure 2.0 guidance, and we heard nothing about Secure 2.0 guidance on his portion. So I'm going to pick up the slack, and I'm going to talk about Secure 2.0 guidance at the IRS, because I know our listeners would like to hear about Secure 2.0. So with that said, let's move to part 2.0 of this podcast. So
The upgrade to the segment.
the upgrade. Don't worry, it's a microtransaction. You can do it through your app, Kevin. It's available on Instagram. But here, the IRS definitely has a lot on its plate. There's a couple things to think about. One of the big ones that we're hearing about that's still out there at this point is, of course, catch-up contributions and the requirements for Roth catch-up contributions. That is at the center of a lot of our discussion, as well as minimum distributions. I'm going to focus on those three. First, let's go backwards. Minimum distributions, the raising of the required commencement age to age 73. Not everybody's computer systems, and logically so, given it passed it got enacted on December 29th, we're ready for the jump to age 73. Now, the IRS gave us some guidance that was relevant in the IRA space for required minimum distributions earlier this year, but we're still pretty silent on, well, transition relief for RMDs and reporting if they should have been eligible for rollover or not. And everybody's been doing good faith. And my comment is, keep going, but I would hope we'll see some of that from the IRS relatively soon. Number two, a big area of attention has been the alleged removal of Roth contributions from the Internal Revenue Code starting in 2024 through a drafting disconnect. As we've talked about previously, the IRS is aware of it. We did comment letters like the Governmental Defined Contribution Trade Group, NAGDA, put in a comment letter. And the IRS seems to have said in sort of informal comments at different conferences, we get it, we're working on it. I think there's a real chance, regardless of legislation, that they find a way to make it clear that catch-up contributions are not going away. Because it's clear as day that the intent that catch-up contributions aren't going away. In fact, if that was the case, why would we have the third thing I'm going to talk about here, which is the requirement that anybody who earns $145,000 in the prior year, starting in 2024, will have to have their catch-up contributions made on a Roth basis. There are a lot of questions out there about this. Can you mandate Roth for all? How do you make it fit together? What about people who don't have Roth right now and are going to have trouble getting it into place? There's been a lot of requests and comments and discussion over this. The IRS, I am hopeful, will send us something on this. And lastly, to quote the Steve Jobs, and one more thing, another item to keep in mind is the long-term part-time employee discussion. Basically, back in Secure 1.0, long-term part-time employees, there was an idea that if they worked 500 or more hours for 3 or more years, starting effectively in 2024, we can get weedy, but that's the short version. Plans would need to let them in for deferral purposes only. And there was non-discrimination testing, safe harbors, and all that stuff that sort of protected you. But the key takeaway was, after 3 years at 500 hours, you let someone in to do their own deferrals. What's interesting is Secure 2.0 changed that to 2 years, expanded it to 403Bs. The IRS was supposedly very close to guidance, and then Secure 2.0 came out. But 2024 is right around the corner, and people have questions, and there's a lot of practicalities people want to work through. So I'm hopeful we will see guidance on that. So now that I have finished 2.0 of the podcast, I'm going to talk a little bit about the Department of Labor, because Jeff, I feel like you were owed an answer on your first question. The Department of Labor has a lot of studies. There's a lot about things like auto portability. There's studies about the effects of things like inflation and other types of changes to the retirement system, and things like indexes for, I think it's managed portfolios, if I remember correctly, in Secure 2.0. I'm probably stating that wrong. There's a lot of reports and guidance required. Kevin's right. We might see interim final rules, and it pains me to say that, but he's right. But notwithstanding that, there's a lot of studies, and studies require reports. So in some ways, maybe we'll see some RFIs, maybe we'll see some DOL initial studies. So there's the chance they'll get things done. And I do think Kevin was spot on, and I'll end on a positive with my partner here rather than a negative, that there's all these people who were out there at the end of December saying, oh, fiduciary's coming. And they would be quoted all over. And it wasn't even at the Office of Management and Budget yet for review. The DOL is still talking about fiduciary, but we'll have to see where it goes, and we could likely see it. But don't get caught up in the hype. We live in an echo chamber in our industry, and sometimes one person says something, and even though there's no basis, it just keeps going and going. So they're going to be busy, but let's wait and see what happens. And Kevin, I'll just end with, I'm glad you could answer the Secure 2.0 question.
Well, David, I'm glad you feel so secure in your regulatory prognosis. I think that I'll do my Secure 2.0 2023 update in December. And I'm guessing that I'll have a higher degree of accuracy.
Kevin, I have no doubt about the degree of accuracy. And by the way, I happen to share your view. The best way to do a prospective review is at the end of the year for the prior year.
And we'll do that.
To me, we're going to sit there and tell everybody we got it completely right because our predictions we didn't tell you. So I think it's spot on, Kevin.
Well, gentlemen, I appreciate it. Look, we enjoy the banter back and forth. We appreciate you guys coming on as always. Thanks so much for sharing a little bit about your a little bit of your expertise with the audience. Look, we look forward to having you back on the program again very soon. Enjoy the rest of your weekend, guys.
Thank you so much.
Thank you, Jeff, and thank you, listeners. It's always great to be on.
Goodbye, gentlemen.
And thank you, Kevin. Bye.
Bye.
But if you're tired of the same
Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. Now, time to talk markets. We're going to take a spin around the markets with Oliver Renick. He's the lead anchor for the TD Ameritrade Network. Oliver, thanks as always for joining us this morning.
Always appreciate the invite, Jeff.
Well, we appreciate your participation and your analysis, and I think it's always spot on, and it gives the listener kind of a look into what's happening in the market every week. Oliver, let's start off with the gross domestic product numbers. Came out recently. Thoughts around that? What does it mean for the broader economy, the health of the economy, and also we'll talk about the stock market.
All right, you got it. Hit me.
Okay, well, let's start with the GDP numbers. I mean, what do you think about them, and what do they mean to you?
Nothing too exciting. Economic data is sort of middling right now. We are seeing there's been a resurgence in housing in particular, which is the most exciting part of the economy right now. A lot of that is happening because interest rates have been contained. Some of it is happening because there is just renewed optimism and asset prices are rising, so financial conditions are loosening, and so people are willing to take on more risk. We've seen this evidenced by the stock market. We've seen it evidenced by crypto markets. We've seen it in housing. There is a huge amount of speculative fervor entering the market again after the last really 4 months this year and extending all the way back to October last year. So it makes sense that some of the economic data should stabilize, and it is a little bit here. I think recession odds probably have been pushed out a little bit, the timeline, and that's a conversation I think is very interesting. I could kind of elaborate on how I think we should consider the idea of recession right now, but there's a lot of people that are looking for like a big shoe to drop in the economy to just fall apart. I've never found that to be a particularly compelling case at this point. To me, this is more a back and forth that ultimately trends downward for the economy. And right now, the back and forth is a big move back higher for asset prices, sentiment, and to some extent the economy. So some of these numbers have been all right. Our beat rate for economic data is better than it was to some extent over the last 8 months, but we're still seeing jobless numbers tick up. We're seeing some cracks in the employment situation. Things are certainly far from perfect. GDP is not really that impressive, but we are getting a nice combination of kind of things that are bad slowing down a little bit, like inflation, things that are, good and desirable, like housing shows some stability. And so we're just sort of lukewarm right now. And I think this really fits with the stock picture because we did have this big rush of bullish fervor in excitement. And actually, when you look at the charts, we've just been going back and forth now, really for much of the past month. That back and forth is skewing towards bulls this week after we got some big rallies from technology companies. But ultimately, the S&P 500 is just below 4,200, which is the high for the year that we were at in February, that we were at the end of March. We were almost there at the end of last year, around 4,100. So we're kind of treading water, basically, in the economy and stock market. And, of course, after this week with earnings, there's some hope that the stock market's going to break out. And I would probably describe sentiment as the most optimistic and bullish that I've seen in about a year and a half.
Yeah, it really sounds like that. And I know since you and I have been talking, I mean, we're always talking about a recession maybe on the way. But we keep on pushing out. I mean, you can continue to do that, right, until a recession hits, until it fits the narrative. Let's take a little bit more of a look at like Treasury yields and the market, because I think there's, people often look at the Treasury yields and say that's a big recession indicator, right? When you have an inverted yield curve, and how have Treasury yields responded, and likewise the stock market? I think you already talked a little bit about the stock market, so let's focus on Treasury yields.
Yeah, pretty much the same, actually, and I think that's a big reason why the stock market is fairly calm, is because Treasury yields, if you look at the 10-year, which a lot of people use as the benchmark, is at the same level it's been at over and over and over again for many months now. The 10-year at 3.4 to 3.5. This is where it was in the summer last year, and then it was here at the end of last year in December. It was here in January, February, March, and basically until now. So the 10-year is an extremely familiar territory, and that is giving, I think, investors a lot of confidence right now that the bond market is not going to be as disruptive a force as it was a year ago. But I do worry that a lot of that is misplaced for the moment, because I think the reason why bond yields are stuck is not because inflation is rapidly coming off or cooling, but because the bond market is torn between inflationary pressures causing central banks to hike rates and the general direction of the economy, which still, even with some of the strength the last month and a half or so, is trending downward from its COVID recovery thrust. And ultimately that's creating a split market where some people are selling bonds at every opportunity, which is basically every time we get to 3.3%, people are selling 10-year bonds, and then they're selling them because inflation is still very sticky. We're stuck at 4.5%, and we're kind of plateauing now. We had a few big drops in inflation from the peak, but now we're essentially looking at the same number we had from the last reading, and that's not good. So there is arguably very good reason to be selling bonds and expecting yields to go higher. But then at the same time, as soon as yields start to go higher, we see that there are still major cracks in the economy, and so investors want to buy treasuries as kind of a safety trade, and ultimately they get stuck. And at some point, the bond market's going to pick a direction, and I think no matter what direction it goes, it's probably bad for stocks. But as long as it stays put and it stays where it's at, that's the market telling us that we're sort of in this neutral, lukewarm, dare I say, kind of Goldilocks situation right now.
Oliver, we've received some positive news about tech earnings, and that's kind of a different picture than what you and I were talking about maybe last quarter. Meta, Amazon, some of the others, I think, reporting better earnings. We're not back to where we were during COVID, right? I mean, those expectations, I mean, probably the earnings helped by layoffs, I would think, cutting headcount, certainly a big help. And then also, obviously, like things like product sales, et cetera.
That is 100% correct. These are totally different companies financially than they were, and fundamentally than they were 3 years ago during the peak for COVID. And to some extent, it's for the better. They're cleaner, they're leaner, they're more profitable, but they are very aware that they're never going to achieve the growth that they got during the COVID pull forward of tech demand. So that really presents a quandary for investors. And at least that's the way I see it. For now, it looks like the market has seen it much more purely bullish and optimistic. But the problem I see is that you now are looking at companies like Microsoft expecting to grow between 7 and 10%, which is not that great. It's fine. It's stable. It's a fine place to be. It's a fine business, and there's still growth there. But there are consumer staple stocks whose revenue has grown by that amount over the past year that trade at much lower valuations and have proven to be bastions in the storm when inflation gives the economy problems. So there is still a very robust debate to be had about whether or not tech companies should be the stocks are buying right now, given that the growth rates are quite reduced and the valuations have come up quite a bit off the lows. That makes a little bit of a difficult needle to thread. I think a lot of it is generally about relief, where I would say probably the most positive thing that I saw from this earnings season was the fact that Microsoft's cloud business, which still grew around 30%, but used to be growing at like double on an annual rate, was in line with analyst expectations. So basically, Wall Street throughout much of the last year and a half was way too optimistic, while these business lines were shrinking. And now it seems like they're roughly on par with the rate at which they're slowing, or the rate at which they're growing. So that, I think, is reassuring that the companies are not disappointing. And that's what a lot of this is about. But there still remains a very big question as to whether or not their businesses are strong and they're growing enough, and if the economy can sustain stock market with these big mega cap companies trading at valuations they reached during COVID. I don't personally think that will ever happen.
Well, I guess it makes for great conversation between you and I, and of course on the TD Ameritrade Network every morning and every afternoon, specifically with Oliver Renick. Oliver, always a pleasure to chat with you for a few minutes. Thanks so much for joining us. Wishing you a great rest of the weekend. We'll talk to you again very soon.
Thank you very much, Jeff.
Bye-bye.
See you.
And that wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more, all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? Well, visit our website and, of course, all of our streaming partners. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.